Let's talk about working capital loans versus revenue-based finance. What is better for your business? So you need $200,000 for your business. The bank says no, but there's another option that can get you funded in 24 hours. But what's the right path? What actually works for your business? Today I'm going to break down working capital loans versus revenue-based finance so you can make the right choice for your situation. I'm Alex Shvarts, and I've been on both sides of the equation. I've seen businesses thrive with traditional bank loans, and I've helped thousands get funded through revenue-based financing when banks said no. The truth is there is no one-size-fits-all answer, and by the end of this video, you'll know exactly which option fits you best. So let's talk about what is working capital. Working capital could mean many things, but it's the capital a business needs to continue working, to continue operations or expansion. Sometimes it could be used for marketing, for whatever needs you feel are important at this time to obtain capital for your business. So let's start with working capital loans. Let's explain them. Traditional working capital loans comes from banks or credit unions. It's a fixed loan amount based on your credit worthiness, fixed monthly payments regardless of your sales, lower interest rates, typically 6 to 18%, and could be longer repayment terms from 1 to 3 years. They require excellent credit, collateral, and extensive documentation. The appeal is obvious: lower cost of capital, predictable payments, but here's what they don't tell you about the real requirements. Banks have become incredibly restrictive. Here's what you actually need: personal credit score of 700 plus, business credit score of 80 plus, 2 years in business with consistent profitability, 20 to 25% down payment or collateral, debt to income ratio of under 40%, detailed business plan with projections. It's a serious checklist. Even if you meet all of these requirements, approvals, they can take 30 days, sometimes 90 days, and there's still no guarantee. I've seen profitable businesses with great cash flow get rejected because their credit took a hit at some point. So let's talk about revenue-based finance and how it works. You sell your future receivables for a lump sum cash payment today. The receivables you sell will be collected based on a percentage of your future sales. The payments are going to fluctuate. So if your sales go up, the payments will increase. If you're having tough times, your sales will decrease. There is no fixed payment amount, and there is no fixed time to repay. The costs with revenue-based finance are often higher, but they're much more accessible. Approvals are based on your performance, not just credit score. Your payments are not fixed. They will fluctuate based on what's going on with cash flow and sales in your business. There are no minimum payments. If you have a day with no sales, you're not making any payments. So let's break this down. You go and you get a traditional bank loan for $100,000 for 5 years at a 12% interest rate. Your estimated monthly payments will be $2,224.44, and the amount of interest you're going to pay over 5 years will be $33,466.69. Now, all banks and credit unions are different, and they might charge you origination fees or underwriting fees up front. We don't know exactly what they are. The approval time can take anywhere between 30 or longer days, and payments will be due even if you have zero sales. You must make those payments. So let's talk about revenue-based finance, of how it works. You sell your receivables for $130,000 for a lump sum payment of $100,000 today. Your payments are going to be based on a calculation of percentage of your sales. Let's say that it's 10% of your sales, and your monthly sales equal $30,000. So 10% of $30,000 is $3,000, and you're going to be making $3,000 a month payments against the receivables that you've sold. The approval time, 24 to 48 hours. Cash in your bank, same thing, up to 48 hours. Payments will adjust with your revenue. If you're gonna have a month where your sales dip or no sales at all, you don't owe any payments for that time. So let's analyze what's better. When do traditional loans make sense? Traditional loans are better if you have excellent credit score, strong financials, and your business has predictable, steady cash flow. You're not in a time-sensitive situation. You want the lowest possible cost of capital. You can handle fixed payments during slow periods. If you're an established business with strong credit and you're planning a major expansion over several years, traditional financing often makes more sense. Now, when does revenue-based finance work or make it a win? Revenue-based financing is better when you need money fast for time-sensitive opportunities. Your credit isn't perfect, but your business is performing. You have seasonal or variable cash flow. Banks have already said no, and you want payments that protect your cash flow. This is especially powerful for restaurants, retail, e-commerce, or any business with fluctuating revenue. We often see medical offices that take months to receive their collectibles. Apply for revenue-based financing because it makes sense. Let's look at some real cases in revenue-based finance. We had a restaurant chain needed $500,000 to open a new location, a third location. Great business, but the owner's credit was damaged from some troubled times before. Banks said no. We approved them in 6 hours and they received cash in 24. They opened on schedule, their revenue increased, they were able to continue to grow the company. We had a manufacturing company, needed $300,000 for equipment. Excellent credit, 10 years in business, steady growth. They chose a traditional SBA loan, took 4 months to close, but saved $40,000 in financing costs over the term of the loan. Both made the right choice for their situation. The cost factor breakdown. Let's be honest about cost. Revenue-based financing is often more expensive up front, but you need to look at the total picture. Hidden cost of bank loans, opportunity cost of waiting 3 months, lost revenue from missed opportunities, application fees, origination fees, legal costs, personal guarantees, and collateral risk. The true cost of revenue-based financing, yes, higher costs, no hidden fees or personal guarantees. It should all be explained up front. Payments that protect your cash flow. Speed that lets you capitalize on opportunities. Sometimes, paying more for speed and flexibility actually costs less in the long run. Let's talk about qualifications. Traditional loans need 700 plus credit score, 2 years plus tax returns, business plans, projections, collateral or some personal guarantee, 2+ years in business. Again, extensive documentation. In order to apply for revenue-based finance, most likely you're going to need a minimum score of only 550. You'll need to be 6 months in business and monthly revenue starting at $20,000 a month. You'll just need to fill out an application and provide 4 months of your last bank statements. That's it. The difference is in accessibility, and it is, in fact, dramatic. So making the right choice. Here's my framework for deciding. Choose a traditional loan if you have time and excellent credit, you need the absolute lowest cost, your cash flow is predictable, you're comfortable with personal guarantees. Choose revenue-based financing if you need speed and flexibility, your credit isn't perfect, you have variable cash flow, banks already said no. The opportunity cost of waiting is high. So here's something most people don't consider. You don't have to choose just one. Many successful businesses use revenue-based finance for immediate needs, then refinance with traditional business loans once they've grown and improved their credit profile. Use revenue-based financing to bridge gaps and seize opportunities, then optimize with traditional financing for long-term growth. Now, there are some common mistakes to avoid. Choosing based on cost alone without considering speed and opportunity cost. Assuming you can't qualify for traditional business loans without actually trying. Not understanding the true requirements and timeline for each option. Waiting too long to explore alternatives when banks say no. So some warning signs. The bottom line is this: the best financing option is the one that gets you the capital you need when you need it at terms you can handle. If you're not sure which path is right for your business, start by seeing what you qualify for. Traditional loan applications are free, and checking your revenue-based finance options doesn't impact your credit score. Click the link in the description to see what funding options are available for your business in under 5 minutes. No commitments, no credit impact, just real information to help you make the right decision. And if this breakdown helped you understand your financing options better, subscribe for more insights that can help you make smarter business decisions. Your next funding decision could make or break your next opportunity. Make sure you're choosing wisely.